Martin Turner here. This week we look at the statement of changes in equity and the cash flow statement and how the financial statements are interconnected. Let's start by looking at the statement of changes in equity. Now we're going to have a look at the statement of changes in equity and the cash flow statement. The statement of changes in equity, for many people, it's the nerdiest financial statement. People can find it a little bit people can find all the financial statements a little bit sort of intimidating. And what are they? The statement of changes in equity is one that people particularly find a bit nerdy. Because it's got multiple columns and it's sort of set out a bit differently. It can be a little bit confusing. So we'll be looking at that. And the second one is the cash flow statement, which is Maria's favourite statement. And also cash. A lot of people like cash. Cash is good. The only way you can go broke in business and in life is to run out of cash. That is the only way. And so cash, something to keep an eye on. We'll then have a minute paper at the end. Now the statement of changes in equity, just like the other financial statements, has no required format or standard terms. So there can be a range of different names, both for the actual statement and also for different terms in those statements. What the statement of changes in equity shows is the various changes in equity over a period of time. So you'll see that it starts with opening balance, the various changes in equity, and then the closing balance. And it does it for 2 years, typically. It's based on the group or consolidated accounts. So for Ryman Healthcare, it's not just the parent company, it's the whole group of companies. And we'll have a look at Ryman Healthcare's statement of changes in equity. So here's Ryman's consolidated statement of changes in equity, and it's for the year ended 31 March 2019, so it's for a period. And you can see here is last year's consolidated statement of changes in equity, and here's the current year one, and they've sort of got it shaded. This is, you see, so for the bottom one, you can see there's the closing balance at the 31st of March 2019, that's a 19 year, and there's the opening balance. So for the 2019, we're only looking at the total equity column. We can see that at the beginning of the 2019 year, Ryman Healthcare had equity of $1.94 billion. It then had a profit and total comprehensive income for the year of $343 million. And that's the bottom figure from down here, 343 mil. That's out of its consolidated statement of comprehensive income. That's the bottom line of its income statement. So Ryman's has put the profit, the net profit, which comes out of the income statement and the other comprehensive income together to just show that one figure. Yours might show two figures to come to that. So that's increased the equity by 343 million. It's also got treasury stock movement, 4.9 million. Treasury stock movement, that's where Ryman Healthcare has bought back some of its own shares, 4.9 million. It bought back those shares because it has a share employee scheme. So it buys the shares and holds them and then transfers them to the staff once they've met the various criteria. And then here's the dividend paid to shareholders, $108.5 million. So that all goes to the happy shareholders, including my children and my wife and various people. So that comes off equity, and there's a 2.17 billion of equity at the end of the year. And there's the last year's figures. So when you're putting in your spreadsheet, this is the figure you put in for 2019, these items. Write all that down, these items, and then there's the 2018 year. You can see there's some footnotes if you're interested in looking at further information. Oops. So that's a statement of change in equity initially. Now, revenue and expenses. Now, we looked at revenue expenses the other week. Revenue are increases in assets or decreases in liabilities of firm that result in increases in equity other than those relating to contributions from equity investors. And expenses is similar, but it's the decreases in assets or increases in liabilities of a firm that result in decreases in equity other than those relating to distributions to equity investors. And so the statement of changes in equity shows these transfers between the firm and its equity investors, such as dividends, share issues, and so forth. And these aren't in the income statement. They're not revenue and expenses. These are the transfers between the firm and its owners. So they're not the revenue or expenses. And it's these, other than those related contributions from equity investors, these do not go in the income statement, but in the statement of comprehensive income. The same for expenses. So that's what the statement of changes in equity is showing us. The differences between the opening and closing balance. It shows the profit and total comprehensive income, which comes through the income statement. And it also shows these items that are not included in revenue and expenses, that are transfers between the firm and its equity investors. So the statement of changes in equity, opening equity, transfers between the firm and its equity investors, such as dividends, share issues, the profit or loss for a period as shown in the income statement, and it may show various other items of other comprehensive income that are not in the income statement, but are in the statement of comprehensive income. Ryman's just shows you the one figure for profit and shows you total comprehensive income, but some break it up. So you can see it here, opening balance, the profit, this is from the income statement, and it just shows profit and total comprehensive income for the year, the whole thing. And then it shows the movements between the owners. This is, in other words, the company's bought back some shares from its owners, and it's also paid some dividends to its owners. So these are outgoings from the company to owners. And that's how they get the closing balance. So that's the statement of changes in equity. Now the cash flow statement, Maria's favourite statement. And for those studying accounting, we'll look in more depth on the cash flow statement in Act 11081, Introductory Financial Accounting. Now the cash flow statement, it shows the changes in the cash. The statement of changes in equity shows the changes in equity. This shows the changes in cash. Cash is an asset in the balance sheet. So it shows the opening cash balance, the cash inflows and outflows during the period, usually a year. So that's the cash in and the cash out, and the closing cash balance. Now the opening cash balance is your bank balance, plus some actual cash. So you might have some actual cash. So that's what your opening cash is. So it's not just sort of cash floating around as cash, but it's your bank balances and cash. And then you have the cash inflows and outflows through the year, and then the closing cash balance, which is your bank balance and some cash. Now the opening cash balance is your cash in your balance sheet a year ago. So we go back to the year balance sheet from a year ago, and we start with its cash balance. And then we go to the cash in the latest balance sheet, which is the closing cash balance. And the cash inflows and outflows are showing how we got from one figure to the next. And here's Ryman Healthcare's consolidated statement of cash flows. Again, it's for a period. You see it's for the year ended 31st of March 2019. And here down the bottom, we have the net increase in cash, the cash and cash equivalents at the beginning of the year. So here's the opening cash balance of Ryman's. And then we have the cash and cash equivalents at the end of the year. So this is the net increase, which is net of all that. The opening balance, closing balance. Ryman's has no cash in its opening balance, no cash in its closing balance, and so its cash flows are just net cash flows are zero. That was the case the last 2 years. And then the cash movements through the year are here. So we've got here's the operating activities. Receipts from residents, $1 billion. Ryman Healthcare, in the year ending March 2019, got $1 billion in cash, which is basically bank transfers, in cash from its customers. These were the customers who bought occupation rights from Ryman's. So the way that works is they're lending the money to Ryman Healthcare interest-free, and they get a lifetime right to occupy a particular retirement village unit. So that's $1 billion. That is a lot of cash. Interest received. It got $588 interest received. It was $588,000 interest received. $500,000. How did it get $500,000 interest? It doesn't have any cash. And opening and closing balance was zero. So how is that? Well, it did have some cash during the year. It's got a lot of cash floating around, hasn't it? It's got $1 billion coming in during the year from its customers. And so it obviously had a bit of cash during the year. Not a lot in the scheme of things, but enough to earn $500,000 worth of interest. And then it had payments to suppliers and employees, $306 million. That's to its staff and also to its various suppliers. You know, it's building a lot of properties, so it's buying concrete and all sorts of stuff, and employees. Payments to residents, $283 million. That's where the residents, when the residents die or go to into care or move out, they then get 80% of what they paid for the occupation rights back, and so that's that payment there. So it's paid $283 million to residents who left their retirement village unit and got $1 billion from people moving in. It also paid interest of $18.6 million. It paid interest because it's got borrowings. If we go to its balance sheet, you can see that it's got quite a lot of debt. It's got bank loans of $1.3 billion. And it managed to pay $18 million interest. Now, so its net operating cash flow is $400 million. Its various investing activities, it purchased property, plant and equipment. So it's investing in new care facilities primarily. That's what its property, plant and equipment is. It's a little bit more than that, but about $150 million. Purchase of intangible assets, purchase of investment properties, $364 million. And that's where it's building new retirement village units and shared facilities and so forth. $364 million. Capitalised interest paid $31 million. Advances to employees $2.3 million. Net investing cash flows $554 million. That includes about $500 million, 364, 150, $500 million where money is being invested in new properties. This is one big property development company, Ryman Healthcare. Not many companies are building $500 million worth of new buildings. Now, we'll see what happens during this current period, but during the global financial crisis, Ryman Healthcare, which is a property development company, didn't miss a beat. It kept building retirement village units. The demand for retirement village units was unchanged. It's needs-based. People needed to go in. So it really didn't miss a beat. And so this is obviously going to have a much bigger impact economically that we're going through now. But it's very likely that Ryman Healthcare will go through this without missing a beat. And certainly I feel like the long-term demand for retirement village units will be unaffected because there aren't really other options. The main option is, it's a very much a needs-based thing. So it'll be interesting to see, but it's a very resilient business model and it could probably just slide through here pretty well, I suspect, and continue to be building $500 million worth of new properties. It pre-sells a lot of the retirement village units, so people have already bought off the plan, and people often come because they need to. They can't just wait another year or two. They've got to go. And so that, and when downturns come on in any industry, or in this case around the world, the good businesses become very visible, and the bad businesses also. So the weaker businesses struggle and often fail, but the good businesses can often perform very well through this. And Ryman Health, so that'll be a test of Ryman Healthcare. Its share price went down from $17, I think, to $6.60 was its lowest point last week for a day. And in my view, its value hasn't changed at all. So you can see there's lots of bargains if you know different companies. There's been lots of bargains on the share market at the moment if you've got cash. Financing activities, drawdown of bank loans, $266 million. It borrowed 266 more money from the bank. So it had loans of 1.3 billion at the end, and it grew them by 266 million. It paid dividends of 108.5 million, purchase of treasury stock net 4.9 million, that's on shares. Net financing flows 153 million. And it just happened that the cash in and the cash out all came to zero, and it had no cash at the beginning, no cash at the end. So that's Ryman Healthcare's cash flow statement. And so you can look at your own firm. And we're going to talk a bit more about all of this as to why do we have statement of changes in equity and cash flow statements. Why is that? When we look at the balance sheet and income statement, it covers all the 5 elements of accounting: assets, expenses, equity, revenue, and liabilities. Assets, equity, and liabilities in the balance sheet. Revenue, expenses are in the income statement. That's it. There is nothing else. All the elements are there. So why do we have these 2 extra ones? Changes in equity and changes in cash. Why do we have these extra financial statements? Well, the reason is, if we're the equity investors, we're interested in equity, in our interests. We're interested in how did the equity change between one time and the next in the balance sheet. And so you can see that the revenue expenses, they affect equity, they change equity, but we saw in the definition, they don't include changes to equity that are simply transfers between the equity investors and the firm. So the changes in equity shows those changes. And we don't go into all the detail of this in this unit, but later, as we go, for those who are doing more accounting, we'll get more into things. You'll see that there are columns in the statement of change in equity on all the different elements. So we're interested in the changes in all the different elements of equity and how they get to the final one. So equity investors are particularly interested in equity. So that's why we have a changes in equity, setting out all the changes. So that's one item in the balance sheet, equity. But we also have the statement of changes in cash flow, which is one of the assets in the balance sheet. There are plenty of other assets in the balance sheet. So why don't we have statements of changes in property, plant, and equipment, something like that? That can be quite a big item. Well, we don't do that, but we have statement of changes in cash flow statement. The reason we have a statement of cash flows is that there's only one way you can go broke in business. Just one way. And there's only one way we can go broke as individuals, and that is to run out of cash. As long as I can turn up to the supermarket and swipe my card, and it all works, I'm fine. But the day I turn up to the supermarket, buying some groceries, I swipe the card, there's no cash left, I've got a real problem. This is not good. And the same with businesses. If you run out of cash, you're finished. But and so it's a very important item for equity investors to be on top of. But we learned about accrual accounting. Does anyone want to type in what accrual accounting is into the comments? What is accrual accounting? Accrual accounting is one of the key ideas or aspects of accounting that you need to understand. And that's something you can reflect on and think about during this term. Most people who know nothing about accounting think it's cash. They think everything's cash. But it's not. In accounting, we use accrual accounting, which means that we put in the transactions or economic events, we record them in our accounts when we judge the economic, when the economic when the economic effect of the transaction occurs. It requires us to make some judgments. And that can often in business be different to when cash changes hands. So the accounts are full of these accruals. But what's been happening to the cash? Well, it's in the balance sheet, the opening and closing balance, but it might be the same or it might be different. But we want to know how it ends up being the same or how it ends up being different over that period. Where's the cash gone and where is it going? And you can see in Ryman Healthcare's cash flow statement, it lays out a lot of that. Oh, look at this, Jake. When we record transactions and economic events in a firm's accounts, it's when their economic substance occurs. That's accrual accounting. But that requires judgments. The cash, and so people could make judgments that are inaccurate, either just through mistake or not being, or just making judgments that are wrong, or it could be deliberate. They might be deliberately making judgments to make their accounts look better. But cash is cash. You can't, there's no judgment about whether you got the cash or not. Ryman Healthcare got $1.009 billion of cash from its customers for aged care centres. As we saw in the cash flow statement, well, there's no judgment about that. You either got the cash or you didn't. So that's why we have the change in equity in the statement of change, cash flow statement in addition. Now, my final point here, this is the critical thing to understand. If you understand this, you understand financial statements. Financial statements are interconnected. They're not just separate things, they're all interconnected. When you see that, when it sort of comes together and you realize all those interconnections, which is the idea, you'll start to realize that more and more over the coming weeks, then you understand financial statements. Revenue minus expenses equals net income or net profit. This is usually over a period, well, it is over a period, usually a year, where we calculate revenue less expenses, less income. Can be other periods. And that's in the income statement. That's what you're seeing in your firm's income statement. Revenue less expenses equals net income. Now that net income or net profit, or total comprehensive income, but let's call it net income, it's transferred to equity at the end of the year. So the income statement shows you the revenue less expenses, how we got to the net income, and then the income statement at the bottom line goes into equity. Equity, which is in the balance sheet. So each year, at the end of the period, it goes into the balance sheet, the net figure, net income. Now the balance sheet is at a point of time. The income statement is over a period. This is now at a point of time. We saw with Ryman Healthcare that it has no cash at a point of time, in both in its last two balance dates. That didn't mean it didn't have cash in between, but it didn't on the balance date. So balance sheet is just a point of time. Obviously, everything's shifting every day, but the balance sheet, just a point of time, which is for Ryman Healthcare, is the 31st of March each year. Now, the statement of changes in equity details the changes in equity between two balance sheets, which is what we're looking at today. How did equity change from one figure to the next? Is everything going all right there, Maria? From one period to the next, between two balance sheets. So you can see it's over a period of time. The statement of change in equity is for the year ended 31st of March for Ryman Healthcare. And it's between two balance sheets. So last year's balance sheet, the equity figure, and the next year's balance sheet, the equity figure there, showing how those two figures in the balance sheet between 2 years, how they've changed. The cash flow statement details changes in cash and asset between two balance sheets. So we're doing asset from last year's balance sheet to this year's balance sheet, the cash. It's over a period, usually a year. And it's between two balance sheets. So it connects cash between two balance sheets. Balance sheets are a point of time. This shows the changes in cash between the two balance sheets. So this is how the financial statements are interconnected. If you understand this, you understand the financial statements. So we're going to do a little summary in a little while, but before we do that, we'll do a minute paper. What was the most important thing you learned today, and what questions still remain unanswered? Now, is this possible to do on the way we usually did it on here? People have called this up.
It should be, Martin. No, I can't see why it wouldn't be. If everyone's just logged into the Echo 360 slides and puts their responses in, you should still be able to access them.
Yeah, I think that's right. That's what I. So if you're not logged in, which you should be, but if you're not logged in, do that and write it up here rather than in the in chat. You can always write things in chat, but let's put it up here. Everyone can see it more clearly. What was the most important thing you learned today? And what questions still remain unanswered? Where to log in, Maria?
You can actually click on the slides itself under the weekly resources in Moodle, or you can log in directly to echo360.org.au and log in, choose CQ University and log in, and that will give you access to all of the Echo 360 slides for every one of your units, and then you'll just have to choose ACCT11059. Instead of typing it in and copying it, I can share my screen and show you where, because you will need to do this every week. So
yeah, why don't you show them how to do it on Moodle, you know, the simple way, just clicking on this week's one.
I'll just open it and share my screen. And then everybody knows where to click it then. So hang on a second, I haven't shared my screen yet. Alright, so you should start seeing my screen very soon. Have I taken over, Martin?
Yeah, you're doing good. You go.
Okay. Okay, so on the unit Moodle site, just scroll down to the actual weekly resources, and we're in week 4 at the moment. So you can click down to the Echo 360 week 4 lecture slides. Every week, Martin links these for you. So you should be, at the beginning of the lecture, clicking into these slides and following along. Because when you get to the interactive components, then you can actually interact with us. And that way, everybody, this is being recorded. And if you do it that way, everybody can see what's appearing on screen. Whereas if you put it on the chat, the recording doesn't pick up the chat. And it also interrupts the lecture a bit if we use the chat too much. So we much prefer you to click into these weekly slides. So this is the one that you need to click into. If you click Echo 360 for your week 4 slides, that will take you directly to the link, and you can then just go to the small thumbnail view, click into slide 32 and type your responses in there, and then we can view them from there. So at the moment there's been 6 responses. I obviously can't type in because I've got lecture access, so you will, for your student access, you'll be able to type your responses in. Okay, I'm going to stop sharing my screen now.
No, you're doing good. You could check. Oh, actually, I can do that. I'll do that. Yeah, you stop.
Okay.
We'll share my screen. Now you can copy. We've got. What have we got? We've got 9 submissions so far. 9 out of 284.
Okay.
There's 106 people actually zoomed in.
I think I took it off your screen, Martin. You'll probably have to share your screen.
Oh, yes, I have to share.
Sorry about that.
That's all right. Ah, can you see it now?
Yep, that's great. Thank you.
Brilliant. So we've got 11 responses. Out of 100, there's 105 people with us now. One person dropped out. We had 106 a minute ago. The 105 responses. What was the most important thing you learned today? You can say nothing at all. I knew it all, or no, that's all right. What was the most important thing? while they're coming in, Maria, do you want to start to comment on some of those?
Yeah, sure. So the most important thing, all statements are interconnected. This might help me understand them a little better. I learned that all the financial statements are interconnected and that Ryman Healthcare had a ludicrous amount of income.
Oh, I like that. It just makes money, Ryman Healthcare. It's so good. It'll be able to make money through this crisis, you know. It'll just keep going. That's my prediction anyway. Yeah, keep going, sorry.
So still going on about the interconnectivity, you've got how the income statement is transferred to the balance sheet, which is very good, and we actually pick on that in the subsequent unit as well. There's when we look at doing a trial balance in the next unit. So this is building the foundations for you. How the different financial statements interconnect. Here's a different one, the concept of goodwill. I love the concept of goodwill. I would have liked you to just explain that a little bit. So instead of saying what was the most important thing that you learned today, if you'd said that the concept of goodwill is, and if you told me about what you thought it was, because we often find that what people think goodwill is a little bit different to what we actually call goodwill in accounting, or what goodwill actually is in accounting, which is really just balancing debits and credits. Whereas, you know, the vast majority of people sort of associate goodwill with branding and company and customer loyalty and so forth. Anyway, I keep going. Cash and equity are the most important parts of a business, and I should probably write something about the statement of changes in equity in my KCQs. I learnt properly about how the statement of changes in equity and the statement of cash flows work. In addition, I learnt about their impact on a firm. So again, it's good that you're telling us about what you're learning, but if you could just explain a little bit more, it would give us better feedback about exactly what you're learning. So I learnt about the impact on a firm, but what is that impact? Cash flow statements, my favourite statement. We deal with cash flow statements in week 10. I'll take you through those in more detail. The most important, sorry, not in this unit, in the next unit, we deal with cash flow statements. We don't deal with cash flow statements in this unit. It's very sad. I'm getting ahead of myself. The most important thing that I learned today is that financial statements are interconnected. So what a statement of changes in equity and statement of cash flow is. So again, it's good that you're listing this. So what is a statement of changes in equity? Just put a little paragraph about your understanding. For example, if I was writing out, I would say something like, it details all of the items of equity in a firm's balance sheet. So it gives more detail about the equity section of a balance sheet. It has its own statement. You know, what a statement of cash flow is. Again, same thing. Statement of cash flows shows, and then just explain in a paragraph. So opening balance, all the different changes, and then you arrive at the closing balance for cash at the year. Revenues minus expenses equals net income or profit. I found it important to see visually how the financial statements are interconnected. So good, statements are interconnected, financial statements are interconnected. The cash flow of a company. So again, it's nice that you recognise that as something important, but tell us what was important. So what about the cash flow of the company? That it's vital to continue trading, that it's the only way that a company can go bust, and so forth. So the financial statements are interconnected. Understanding the statement of changes in equity. So again, a little bit more elaboration would be good, just so we can gauge your understanding what you actually really did take out from the lecture. I didn't learn much today. I spilled my coffee all over the table and just finished clearing it up. I know, I have those days. It's all right.
That is such a good response. That's brilliant.
Statement of changes in equity and the cash flow statement. Details changes in equity and the cash between two balance sheets. Very good. Fantastic. That's good. That's a good comment. Where all of the elements fit into all of the financial statements and that the elements are interconnected. Yes, very good. So this is a good takeout. You could even add to that comment by saying, for example, assets, liabilities and equity are on your balance sheet. Equity is explained in detail in your statement of changes in equity, and cash is explained in detail in the statement of cash flows. You know, so the cash balance on the balance sheet is explained in detail. So you can show us that you understand the interconnectivity. That all the financial statements are interconnected. The most important thing was that they are interconnected, how they're interconnected. So there's a few interconnected. The formulas of net income and revenues, I think this was the most important aspect, as revenues are important for the survival of the company. This could also help in completing the structure of the annual report by, I'm not sure what that word is, all assets, equity, expenses, and more. Do you know, it's that second last one or fourth last one now, Martin. Can you interpret that? The formulas of net income and revenues. I think this is
formulas of net income and revenue. So that's the revenue less expenses equals profit or net income. That's really good to get into your mind. And revenue and expenses are temporary accounts. You can see how they get emptied out into net profit or net income, and then that net number gets emptied out into equity every year. So revenue expenses start empty at the beginning of each year, but assets, liabilities, and equity don't. They keep going. They keep going. So I think that was the most important aspect, as revenues are important for the survival of the company, and this could also help in completing the structure of the annual report by bifurcating all assets, equity, expenses, and more. Anyway, I think that's how I would read that. Certainly that revenue, if you make sure revenue less expenses equals profit, is a great thing to have clear.
Yeah, I agree. Then we've got all financial statements are interconnected. The formatting and elements of financial statements and how they show the backbone of a company. This is going to help me in the future and reading over my assignment when picking at the little details. It's all connected and it all works together. I'm learning so much about accounting. So that's good. Again, you could probably flesh that out a little bit by stating how they're connected, so showing the connection, and also stating that they are the backbone of a company. I think it's more about communicating position and performance about a company, but good insights. I understand some aspects, but I'm half asleep trying to active learning. That's because you're not relating it to your personal experiences. try and think of some examples to use when you're when Martin is talking about these key concepts. That'll help you with your active learning. The basic formulas of revenue and income to know firm's financial position. So going back to that, revenue minus expenses is your profit equation, and how the different financial statements are interconnected. So I think that's some pretty good takeouts there, Martin. Great.
So yeah, if you understand nothing else and that financial statements are interconnected, you're probably streets ahead of most people. Most people sort of seem to think they're separate. And if you can start to get a feel for how revenue and expenses are temporary accounts, they flow into the equity at the end of each year, and also how the statement of changes in equity and cash flow statements fit in. That sounds good. We got 29 submissions out of 109 people here. So about 30% of people wrote in. You can write anything you like, including I spilled coffee all over my computer. There's all sorts of stuff happening everywhere. And so that's some interesting points. And all right, let's move to the next one. What questions still remain unanswered? What questions still remain unanswered? We've got 7 submissions. What would you like to know? We will answer these questions if we can. As long as they're questions we can answer, we will answer them.
Oh, Martin, I'd love to answer the first one.
Oh, you can't wait, can you?
I can't wait. And actually, I've even got a little diagram that I can show because...
Oh, right. Okay.
I drew it.
Everyone, we've only got 8. What questions still remain unanswered? You can ask anything you like. What questions? All right, we'll do the first one, Maria. We've got 10 now.
All right, so to answer this question, it takes me right back actually to when I was teaching principles of accounting years ago. And I used to actually draw, we used to manually do the recording process from, recording your transactions through to journals and posting it to ledgers and preparing an unadjusted trial balance and doing your adjusting entries and so forth, right through to preparing financial statements. So it's a good question that has been asked. And I'm really tricky. I'm actually gonna try and work the document camera on this computer. They showed me how to do it. I actually had IT come and show me, so I'm a bit excited to test it out. I did test it out on Friday. So I'm going to show you my diagram that I drew on Friday in the subsequent unit, because I explained this then as well. So it's something that we can carry through. It's a key concept that carries through, I suppose. All right. Let's see if this works now. Okay, I'm going to share my screen and then let me know if you can't see my UView little document camera. Can everyone see? All right. Let's zoom it a bit so you can see my wonderful diagram. It's not very clear, is it?
Yeah, it's still getting into focus a little bit.
Yeah. I wonder how I can make it focused. Oh, I almost had it there. There we go. All right. So this was my little train. So I used to call it the choo-choo train, and students used to hashtag choo-choo train it. But this shows the process of recording, and it shows you which financial statements we prepare at which time. So you start with your transactions, and then we record those transactions into an accounting language of journals. We put them in special places called journals, and then we go along this little train carriage process of bookkeeping and recording. Now, Martin mentioned today that revenues and expenses are temporary accounts, and this is where we get to this point in the process where Martin was talking about today. We call a process of closing the books a period where we empty out the revenue and expense accounts, or those temporary accounts, and we close them off before we start the new recording period. Okay, so revenues and expenses are temporary, and we actually close those accounts at the end of every reporting period so that they can start afresh at the new one. At this point in time, before you close those revenues and expenses, this is where you would prepare your income statement or your profit and loss statement, because after this closing process, okay, once you do the post-closing trial balance, you won't have revenue and expense accounts to prepare the rest of the financial statements. So this little asterisk here shows you at this point, you prepare your profit and loss or your income statements first, then you go through the closing process, and then you check the closing process, which is what a post-closing trial balance is all about. And then you'll prepare the remaining financial statements. And usually we prepare them in the order of balance sheet, statement of changes in equity, and then cash flow statement. Okay, they can be prepared in any order. It's this important little section here, which is why we prepare our income statements first. Now, that's in a manual bookkeeping or accounting world. In practice, everything is electronic. So you just put your journals in, essentially. So you'll put journals in at this point into an electronic system. It automatically posts to ledger and does your trial balance for you. Then you will put your adjusting journal entries into an electronic system. It will automatically post those to ledger and produce an adjusted trial balance for you. You will also put journals in to close. Sometimes this is just a button in some systems. You will literally click your menu and you will click closing, close the period, and you won't even have to manually type journals in. It automatically does this for you in an electronic system. And then you press a button to get these. So at any point, your electronic system will prepare your financial statements. But I thought if you just remember the little train process, we always, at this point here, before we do the closing of the temporary accounts, we always do the income statement first. So that was my little choo-choo train, Martin.
Very good. Very good. It gets better every year, that choo-choo train. I think that gives a little sense of just the order in which you do it. But obviously, you need to calculate your profit first. What I'm saying. Well, keep going. You want to go to the next one?
Yeah, you'll have to share your screen. Again, I kicked it off when I took over. Great, okay. So that was the process in which statements are sort of filled out. What order do they go? So usually we will lift your income statements first. The conceptual framework, financial statements, which you can access from the AASB.gov.au site, will actually specifies the order in which you present them. Okay, so you usually have your income statements first, and you'll have your balance sheet, statement of changes in equity, and your cash flow statement. That's the usual order of presentation. And the AASB 101 actually explains what is those key financial statements as well. So definitely recommend that you have a look at those as a key resource. Is peer review drafting necessary for the assignment, or is it just advised? It's definitely necessary. You must be able to show that you have provided to other people quality and thoughtful feedback to at least 3 of your peers. So it is necessary for your assignment in both sections. Can there be mistakes in the financial statements? For sure there can be. I always tell the story of one year. It was around the time when the statement of changes in equity came out, because we never used to have that statement. When they first decided equity was important enough to have its own separate financial statement, they released something called the SORI statement, S-O-R-I-E, which is Statement of Recognised Income and Expense. And of course, I was analysing Wesfarmers, my beloved company at the time, and I was trying to reconcile my understanding of this SORI statement to the balance sheet. And I found I was out by $3 million, and I could not find it. And I thought, I'm doing something wrong. I just can't reconcile this $3 million. So I did what I normally do and tried to contact the company. And one of the Wesfarmers accountants actually got back to me, which is another reason why I love Wesfarmers, because they actually get back to you. Some companies don't. And Luke was the accountant from Western Australia. He was based for Wesfarmers, and he got back to me and he said, yeah, the reason you can't find the $3 million is because it's a mistake in the financial statements. He says, you found one of 2 mistakes in those financial statements. And he said, but because $3 million is considered immaterial in light of revenues, $1 billion revenue turnover, the auditors didn't make us restate the financials. So we could just keep them as is. We didn't have to recall them and reissue them. And so I said to him, wow, okay, so where's the other mistake? Because he said it was one of 2. And he's like, I'm not telling you. And I could never find it. So, yes, there can be mistakes in financial statements. I do not think I have any further questions about week 4. It's good. I'm still a little confused about the concept of restated financial statements from an accounting point of view. This appeared in my first financial statements. And I would really like to know why. Maybe I will find this out in a future accounting unit. No, you find that out in this accounting unit. Okay, so normally, I think next week actually when I start, it might actually be in the pre-recorded videos that I do. I talk about restating. Yes, it is. It's in the pre-recorded videos for your assignment. I actually cover what restated financial statements is, and it's different to the restating that we do in our unit for assignment 2. Okay, so restated financial statements simply means that your company has changed a way of presenting their financial statements from one year to the next. And so when they're allowed to change certain things like accounting policies and procedures, but when they do, they have to go back and restate the previous year's comparative figures as if they were prepared using those same changes in policies, so that they are comparable for the users to make decisions from. So that's what restated financial statements are in your company's annual reports. You'll see a little word that says restated, and Wesfarmers has restated income statements, I think. So in the pre-recorded videos, I do explain that there. But that's what restated financial statements is, different to the restating we do in the unit. More about that in upcoming weeks. So this has appeared in your financial statements, and yeah, so that's why. So hopefully that's answered that. I believe there may be more to the statement of changes in equity and cash flow statements. Also, an income statement can $1 below the actual value impact the overall statement to dramatic effect, and how? So first of all, the first part, I believe there may be more to the statement of changes in equity and cash flows. There's so much more. The statement of changes in equity is actually one of the most confused, one of the statements that confuses most people. So it's really important that you study it well and that you can follow through the changes in each of the equity items. For your assignments, we only get you to put the total in, but I always say it's really good to just have a look at what items of equity your company has and have a look at what changes were made in each of those items. Don't be scared of them. Some of them have got really weird and wonderful names, especially in the type of reserves that your companies might have. But take that as an exciting opportunity to really learn something that not many people know much about. Okay, so if you're not sure about what a term means, talk about it with your peers. Ask the question on the forums. Do a bit of Google researching, do a bit of proper academic researching about what those terms are and what it actually means. So yes, there's so much more to statement of changes in equity and also the cash flow statements. We don't look at the cash flow statements in this unit, but come along on that journey in the next unit with us. Also, an income statement can $1 below the actual value. I think that means if you're $1 out. So with your companies, when they present their financials, they usually will present them in thousands or millions of dollars or billions of dollars if your company's that big. So if you are out by $1, it could either be $1,000 or $1 million, depending on what format your company has presented those financials in. Usually that's considered immaterial, and usually it can be out due to rounding. So sometimes because your figures are rounded, your totals may be out by 1. We're not too concerned about that. Okay, so you can just fix that in your Excel spreadsheet and just mark there that it's most likely due to the rounding of such large figures that your company is presenting. Why would my total comprehensive income for 1 year have 2 different values? In changes in equity compared to the statement of profit or loss, all other years match. Everyone's saying they're interconnected. Okay, so your total comprehensive income for 1 year will have 2 different values if it's restated. So as we mentioned before, you could actually have original figures from 1 year and then they will be restated in a different report, but they should always match in that particular report. Okay, so in the original report, you shouldn't have 2 different figures. You should have one total comprehensive income, which will be shown in your statement of changes in equity. Okay, so we close all of our profit and loss and comprehensive income off to your equity or your, one item of your equity. So usually retained earnings for your profit and loss, and sometimes retained earnings plus other aspects of reserves and so forth for your other comprehensive income. So that figure for your total comprehensive income should only be one value in every report, okay, for every year. If you think you have 2 values, then you're probably looking at 2 different figures. A lot of students will confuse the difference between other comprehensive income and total comprehensive income, and there is a difference. It's a huge difference. Other comprehensive income is just all of the items of your comprehensive income. Total comprehensive income is the other comprehensive income plus profit. Okay, that gives total comprehensive income. So just make sure what you're looking at and get to know it. It's really important you spend the time to learn these things and ask the questions and discuss them with your peers on the Facebook page and so forth. And definitely they are interconnected. So your total comprehensive income, you will find your profit and your items of comprehensive income in your statement of changes in equity. And that's actually a really important point. You will see in the pre-recorded videos when you're restating that that I actually show you how we double check. It's one of the checks between the restated statement of changes in equity and the restated income statements. Okay, none. Question relating to the assignment, but I will ask that in the tutorial. That's good. That's what your tutorials are for. Why did Zoom crash last week? Yeah, it was just learning how to handle everything. How can I master using the Excel spreadsheets? Practice, practice, practice. That's how you master anything. How do you play the piano well? Practice, practice, practice. How do you learn your accounting rules? Practice, practice, practice. So how do you master using Excel spreadsheets? Years and years of practice. And you'll be actually surprised. how quickly you pick it up. It's quite an intuitive system, and there's lots of good formula and shortcut keys that you can get used to really fast. I've never used Excel, but I want to get better at using it, so that's good. I always say, so students send me lots of questions like, do I really have to format? Do I really have to make it pretty? Because in the recorded videos, I say, I really like you to format and I really like you to make it pretty, because that not only makes it nice for other people looking at your spreadsheet when you ask your peers to give feedback, as well as for the markers marking your spreadsheets, but it helps you use Excel better. Okay, so by you exploring it and taking the time to find out where the different format options are, how you format it, that's just helping you to become better at Excel. So it's all how detailed you go into presenting or preparing your Excel spreadsheets for your assignment is really what you're going to learn and how much better you're going to get at Excel. So I would definitely say use this time and use this unit as one of the tools and stepping stones to learning to use Excel better. We also have some Excel experts. We always have 1 or 2 Excel experts in our unit cohort going through. So if you are stuck on Excel, post your Excel question and those experts will hop on and they will tell you how to do it really well. Is there any substitute for a financial statement? I don't think so. Martin, have you ever had that question before? I've never had really anyone ask me for a substitute financial statement.
No, if I'm reading that right, there are quite a lot of rules around accounting in terms of accounting standards, and so the financial statements are defined, what we use. And so that's why you see a lot of similarity between different companies in Australia and also when we have overseas. And it's a little bit like, somebody's face. We can see each other's face. They're all very different, but they sort of have some similarities. Usually there's 2 eyes and a nose and a couple of ears, that type of thing. And it's a little bit like that. So, yeah, there's no substitute. You're required to present these different financial statements under the accounting standards. I think that's, unless you've got some thoughts on that, you can chat if that's not answering that particular question. But, yeah, back to you, Maria.
Okay, thank you. I'm actually stumped on the next one. I think they're the same, but I might leave you for that one. It just says, is there anything different between share-based payment charge and share-based payment credit? Same thing?
No. This is quite a good question, because when you start looking at the financial statements, you realise there's a whole lot of terms there that you haven't got a clue what they are, when you're just looking for the first time. And then not only that, when you start talking to other students, you can have the same item that's actually got a different name. So I don't know the exact details. You have to look at that particular company on share-based payment charge and share-based payment credit. But these share-based payments, which it depends on the context, but they can be, for example, to employees, as part of their package, picking the more senior ones. And so it might be related to that. It most likely is, but it could be something else. Yeah, but I think the main takeout for everyone here is that there's no standard terms in accounting. So there's a range of terms for the same thing. And companies can sometimes even change the terms over the years for the same thing, or there can be the same terms for different things sometimes. So you just need to be a little bit aware of that.
That's a great point, actually. I meant to say, I've had a few emails from students saying, oh, my company says this, my company says that, and what is it? And I'm like, they're actually the same thing. So we tend to use lots of different terms for the same thing. So it's important to get to know the substance of your items in your financial statements. And that's why, and I often get a lot of emails asking, what is this, and what is this, and what is this? And so I turn that back on you and I say, you find out what it is and then you explain it to me. Because there's no point me sitting here telling you my knowledge, because you'll forget it. But if you go out and you find out what it is on your own merits, then you're much more likely to remember what that actually is. So in the future, when someone asks you, you'll remember, instead of going, oh, Maria did say, but I've forgotten that. Okay, so next one, I'm good. And then my financial statement in 2018 is called Statement of, and then changed into Consolidated Statement of in 2019. Why is this the case? Okay, so we want you to use consolidated statements. And what consolidated means is that it's the group accounts, okay? So every company, and I explained this in the pre-recorded videos as well, so just repeating there, but every company can own other companies, okay? And if they own and control other companies, we call them the parent company, and we call all of their little children companies, we call them subsidiaries. So when you present financial statements, the parent company must include all of the other companies' financial statements that it controls, okay? And we call those the consolidated statements, financial statements, because it consolidates all of the financial figures of all of the companies in that group. So that we do want you to use consolidated statements for your assignment. Please use consolidated statements. Don't use your parent figures only. Okay, so please make sure you use consolidated. Sometimes they don't have to state consolidated in the actual title, but sometimes they will if in 1 year they've presented more than one set of financial statements. And companies can do that for various reasons. So they might like to produce, some companies will also produce concise financial statements in the same document that they produce consolidated financial statements. I've seen that with one of my Mackay students. They had a concise set of financials in the same document as their consolidated financials. Ignore concise financials. Concise being very abbreviated. We don't want you to use concise. We want you to use consolidated, the big word, the one that includes all of the financial statement figures. So hopefully that's answered that. If not, let us know. That's it, Martin.
Thanks, Maria. In relation to that last question, make sure you clarify that in the tutorial if you're going into a tutorial, or if just check that you've got the 2018 accounts right, that you're using the consolidated accounts rather than the parent accounts. It's usually not a problem, but you want to make sure you haven't done that. So double check that, and if you like, you can. If you're not going to a tutorial, you could email me about it. Just send your spreadsheet and your 2 lots of annual reports, and just want to make sure with your first assignment that you've got the correct annual reports, the correct financial statements into your spreadsheet. That's the key thing with the assignment 1, and that'll be a good foundation for you to do assignment 2. If you haven't done that too well, or made some mistakes, it'll all become apparent later on, and then it's not a good outcome. You have to go back and fix things up. Well, thank you, Maria, for that. That brings us to the end.
Excuse me, Martin, just quickly.
Yep.
This is Lois here. I just wanted to mention that sometimes consolidated accounts in financials are actually called group accounts as well. They're exactly the same thing, but they can go under different titles.
Yep, that's great. Thank you, Lois. That's right. They could be group, they could be consolidated. They tend not to be called too much else, but that's right. Thank you, Lois, and good to hear from you, Lois. And all right, well, thank you very much, everyone. We might leave it there today. We'll just do our summary. What we've looked at today is the statement of changes in equity, the most nerdy financial statement for many people, but you know, it's not that difficult to get a hold of once you understand how it's structured. We'll be focusing on the total equity column rather than the other elements, but you can see how it shows the changes in equity, and in fact each of the items in equity, how they've changed during the year. The reason we have that is because the equity investors are particularly interested in the equity and want to see how that has changed during the year rather than just see the figures in the balance sheet each year. And the cash flow statement shows us the change in cash from one balance sheet to the next. It's one of the assets, but the reason we have a cash flow statement and not a statement for other things, other assets or liabilities, is because for 2 reasons. The cash, if we have, the only way to go broke is to run out of cash. If you run out of cash, you will go broke so fast. And that's what we're seeing here with the economic impacts from the coronavirus, is that a lot of businesses are having their revenue dry up, like airlines and so forth. If they run out of cash, they're finished. They can't do anything. and the same with small businesses and so on. So cash is key for survival, and the same for personal. So if some people keep a bit of cash to the side for emergencies and so forth, that's because when stuff happens, cash is king, isn't it, to keep you going. So that's why we're interested. But there's a second reason why we're interested in the cash flow statement, and that is because the other statements are grounded in accrual accounting. All the other financial statements, it's accrual accounting, not the cash flow statement. It's not accrual accounting here. This is the cash. Most people think financial statements are just, and accounting is cash-based, but it's not. It's based on accrual accounting. And we had some definitions of accrual accounting come up on the chat. And that's we recognise transactions and economic events in the accounts when they're at the time, when we judge that the economic substance of those transactions has occurred, which can often be at different times to when cash changes hands. So it's possible to make a lot of profit and to be losing cash every year. Ryman Healthcare is like that. It makes a lot of profit, but it has a lot of cash going out every year because it's investing in all these building these new retirement villages. You can see how it's borrowed $266 million last year to keep itself afloat. So it's got negative free cash flow, but it's got strong profits. So the cash statement shows where that cash is coming and going from. And as an equity investor, we're very interested in that. We then did the minute paper. There were a number of comments about the key things you learned. One of the big takeouts many mentioned was that they're starting to understand how the financial statements are interconnected. A range of other good questions, other good comments, and then the questions people have had there were also some quite good quality questions. As we develop going through the unit more, you'll keep having more questions. If you're learning for understanding, you'll be asking yourself questions. What does this mean? And as you do that more, there'll be more questions. So you get the opportunity to ask them in various venues. Well, thank you very much, everyone. And thank you, Maria. And I suspect your train illustration will be a highlight for a number of people today from our class. And we'll leave now, and then we'll go and join our tutorials, which in Rockhampton anyway, we start at 10:30 with the tutorial, but whenever the others start. And thank you very much.